This week is going to be absolutely crazy, from economic data, select few important earnings, and the potential of a continued market bounce. Or do we get rejected and going to fall to new lows? We will discuss that here in this video. So first up, let's start with the economic data for this week. On Monday, we have consumer inflation expectations. Not expecting that will be a big mover at all. And then the monthly budget statement. Again, I don't think that's going to be a big driving factor of markets. And that's it for Monday. So Monday could be a pretty slow day. Tuesday, you have PPI month over month. We are expecting 0.1%. Last month was 0.2% for your headline PPI number. That's going to be the first piece of bigger data that we have this week. But as I have mentioned before here on this channel, I don't think inflation or the Fed really matters to markets right now. Unless we get, hotter than expected data. I mean, I think the markets are pretty comfortable with the fact that inflation is falling, okay? I don't think it's going to be a big surprise that inflation does fall. And in fact, if inflation starts to fall more than expected, that's actually a bad sign for the economy. Because the last thing you want's deflation. Deflation's worse than inflation, and then you're really looking at a severe recession. So in a way, you don't want to see deflation. Like, you want to see the inflation just stay around where it has been. Okay, so PPI can be important, but I don't think it's going to be a big market driving catalyst of this week. You have Fed Bostic that speaks at 1:15 Tuesday as well. That is Eastern Standard Time. Now on Wednesday, you're going to get CPI. Now again, as long as CPI core month over month does not come in hotter than expected, I think it's going to be a small reaction to markets, okay? We are expecting 0.2%. The forecast is 0.3% month over month. So if we come in hotter than expected, that's going to be a negative, right? But lower than expected or in line with expectations, I'm not expecting that is going to give the markets much of an upside reaction. That's just my personal opinion. I think it's all about the economic data at this point, as long as inflation does not come in hotter than expected. Core year over year is expected at about 3.2%. Last month, we were 3.3%. So a little bit of a down move there. Headline inflation month over month is expected to go from negative 0.1% to positive 0.2%. And year over year inflation is expected to fall from 3% to 2.9%. So those are your expectations. Let me know what you think we could actually see for inflation coming Wednesday. You have seen container freight shipping prices really starting to rise recently, and that has some people concerned about the reflation that we could see. Although I don't think that is very likely at this point. I do think consumers are revolting against higher prices. By far, the most important day for this upcoming week is going to be Thursday, August 15th, in my personal opinion. You will get retail sales month over month. Last month, you came in at 0%. We are expecting positive 0.3%. If that's the kind of number we get, I expect markets will be very happy on that news. If we get a negative number or another, let's call it 0.1 or 0% number, just a lower than expected number, I don't think it's going to be that big of a problem. But if you get a negative number, yeah, that's going to be a big problem, okay? But just barely missing estimates, coming in a little bit lower, I think the markets can actually still rally on that, because again, the markets are going to start to form this mentality of it could have been worse. It could have been worse. It could have been worse. And that's what I think could start this week. So retail sales is the most important data point of this week, in my personal opinion, which any other normal time, it's always been CPI. But I think markets are more focused on the economy now than inflation. You will get export prices and import prices month over month, as well as your export prices and import prices year over year. And this will move the estimates for the Atlanta Fed GDP now tracker, which is currently sitting at about 2.9% for Q3 GDP. The average economist estimate is about 1.8% Q3 GDP. So those numbers will move the needle for your GDP estimates. You will also get other things, inventories, industrial production, manufacturing production, and business inventories that will also move those GDP estimates. But beyond retail sales, initial jobless claims is probably going to be the next most important catalyst. All of this data comes out at 8:30 in the morning Eastern Standard Time, by the way, on Thursday. We are expecting 232,000 initial jobless claims for the week of August 10th. Last week, we came in at 233,000 initial jobless claims, and that was actually the catalyst that gave us the best green day, the highest gain in a year for the S&P 500, was coming in 7,000 lower than expected for initial jobless claims. So I think that's still going to be important. Now, New York Empire State Manufacturing Index, expecting that to be roughly the same as last month, around -6. Philadelphia Fed Manufacturing Index came in at, or is expected to come in at 7, so a little bit worse. And retail sales, excluding autos, month over month, is expected to come in at 0.1%. That's another important one that Wall Street will pay attention to, specifically in regards to retail sales. You will get Philly Fed business conditions, Philly Fed CapEx index, Philly Fed employment, Philly Fed new orders, and Philly Fed prices paid. Prices paid is going to be the most important metric of that report, so we will see how that goes. Fed Mausoleum does speak at 9:10 in the morning as well, but not expecting much out of that. So that is really your major catalyst for Thursday. You also have Fed Harker that speaks at about 1 p.m. as well. And I think Thursday's going to give us the next maybe 2% move for markets, depending how the data goes. On Friday, we will get building permits that come out at 8:30 in the morning. I don't think this is much of a catalyst at all. It's been a catalyst because if you get more building permits, that's more building, that's more housing, that's less housing inflation. Again, I think inflation at this point is not as big of a problem from the market's perspective as the economy. So I don't think that will move things at all, really. Let's just be honest. But Michigan consumer sentiment will be important. That comes out at 10 o'clock in the morning on Friday. We are expecting a headline number of 66.7, which would be a little bit of an improvement from last month. 5-year inflation expectations are expected to stay the same at 3%. Michigan consumer expectations are expected to fall from 68.8 to 68.2. And Michigan current conditions are expected to fall as well from 62.7 down to 62.3. Inflation expectations for the 1-year period ahead are expected to come in line with what you've seen last month as well, at about 2.9%. So it's actually interesting that you're expecting that headline number on this survey to go up, but you're actually expecting consumer expectations and current conditions to fall a little bit from last month. That might just be an error in the way that we're seeing the data, because I don't think that's possible. The headline number could go up if these other two components are expected to go down. So really, long story short, Thursday is your important day for markets. That is going to be the day in which is really going to guide investor sentiment going ahead until we get larger economic data, which retail sales, I mean, the consumer spending money is like 70% of the economy. So that's a main focus of investors this upcoming week. And as far as earnings for this upcoming week, you have a lot of just random companies reporting on Monday. On Tuesday, you have Home Depot pre-market. I think that can be important. Again, not necessarily a company people need to go to. It's more of a luxury company that people go to, fix up their homes, to DIY projects, right? So Home Depot can be very important. You have Nubank Tuesday and after hours, but that's it. You have Dole and some other companies like UBS that report Wednesday pre-market. Wednesday and after hours, you have Cisco. That's probably going to be the biggest one. One of the bigger ones of this week. Thursday pre-market, you have Alibaba, you have Walmart. That's a very important company. Walmart, back during 2007 or so, was one of the first kind of signs we had of a broader slowdown in the consumer. What Walmart has to say will be very important. I will be paying very close attention to what Walmart has to say, because I think they are probably the best company out there to give us information on the economy and on the consumer. If Walmart says the consumer is doing just fine, people are spending money, then that will alleviate quite a bit of my concerns. If Walmart has negative things to say about the consumer, if they expect the consumer is going to slow down even more, then I will really take that as more or less hard data, if you will. It's something Wall Street may not pay too much attention to, but it is absolutely the most important company in regards to kind of evaluating the consumer. So that'll be important. JD.com, John Deere, Grab, and some other companies. Thursday and after hours, Applied Materials could be important for the semiconductors. And on Friday, you have Flower Foods and, a couple other smaller companies there. So this week's earnings lineup, it's not any important companies that will, broadly speaking, move the markets, but Home Depot, Walmart, we need to see them say good things about the consumer. I don't know if Wall Street will pick up on any negative things said about the consumer in conference calls or whatnot. I don't know if the markets will broadly react to that, but it's something I will pay very close attention to. Before we go any further throughout this video, I do want to share this clip with you. It's from Renaissance. Dutta, he has become a big face of the investing community in recent months. You'll also see Josh Brown in this clip as well. But he says, I have no confidence the unemployment rate will stay where it is. And I think this is very valuable context that you need to know if you're investing in markets today.
Fed's next move front and center as investors brace for a week of pivotal economic data. Joining us on set for his take is Neil Dutta, partner and head of economic research at Renaissance Macro Research. So, Neil, they said it. Tom Lee saying the Fed needs to be less data dependent. Jeremy Siegel thinks the market knows better and should be listened to. But he did backtrack on those comments slightly later. But, I mean, where do you stand on where the economy is? What is demanding of the Fed right now?
I think the Fed needs to get on with cutting interest rates. I think they should do a large upfront move. If you look at their economic projections for 2025, Mike, they have the unemployment rate at 4.2%, and they have core inflation at 2.3%, and then they have the Fed funds rate at 4.1%. We're at 4.3% unemployment. Core inflation's been doing that at 2.3 for the last 3 months. And the Fed funds rate's at 5.5%. So I think it's sort of like which of these is not like the other.
And you were saying this in advance of some of the July data. I wanted to also make clear, so you're not saying because of what happened in markets over a few days?
No, I think the markets are a sideshow. I mean, why did the market sell off in the first place? I know people want to talk about the yen carry trade, but the big sell-off in the markets happened in the 2 days after the Fed met, because the data was really weak. And we have a lot of data coming out next week. And if that's weak, I would anticipate, some pressure.
Do you agree with what Professor Siegel is saying? Conceptually, the Fed needs to start making forecasts? Because there's a long line of people who would say, okay, maybe forecasts might be superior to data dependent, but how good are the Fed's forecasts? Not a great track record.
No, I agree with that. I mean, I think this isn't about forecasting. This is about just adjusting the policy rate to what we've already seen happen. The unemployment rate is up. It's been rising for 5 of the last 6 months, and core inflation's been coming in below expected for the last 2 months. And what's the Fed doing? Oh, we have time. We can wait. We just need a little bit more data. I mean, to me, it's a little bit ridiculous. So I do think they're kind of like holding on to this higher for longer a bit past the expiration date.
The counter to that, as you know, is, well, the unemployment rate is up because labor supply is up. The layoffs are not that worrisome. And so there's sort of a cushion maybe structurally tightness in the labor market? You know what I'm getting at.
Yeah,
even people say, hey, construction employment is actually up, and that's always been a better recession.
Immigration has resumed is another thing that you're hearing.
I think it's sort of like a little bit too much like PhD think. I mean, I look at the unemployment rate historically. It's a line that's either going up or down. It doesn't move sideways. If it's moving sideways for an extended period of time, it's because usually the Fed does something, right? So, and then if you think about the outlook, like what about the outlook gives anybody confidence that the unemployment rate will just stabilize here on its own? I mean, housing is slowing. If you look at new home sales that haven't been started, that's down over 35% against last year. That's going to weigh on construction. You're not going to get the kind of inventory investment boom that you saw in Q2. And incomes are slowing, which is going to weigh on consumer spending. So, yeah, I don't have any confidence that the unemployment rate will just stay where it is. Looking at layoffs, I mean, you're going to be waiting too long because that's usually the last thing to happen.
What do you think they're going to do at Jackson Hole in terms of rhetoric and messaging? Where are you placing your bets?
I think that they're going to basically do a little bit of a victory lap and say that the inflation issue's been resolved. And I think that, and that the balance of risks have changed, and that'll set them up to cut in September.
That's code for it. Yeah. We're going to try to get moving. Part of the big bullish case for risk assets, if you go back to the highs in July, I was saying this too, was the certainty that we were on a path for a soft landing and that the Fed was going to ease, but it was going to be able to do it deliberately for the right reasons because inflation was coming down, and slower easing cycles historically are more bullish for stocks than rapid ones when the Fed is kind of rushing to rescue the economy. Do you think they have room to sort of take it slow if they start in September?
I don't think that they should take it slow.
No.
It's not about what, I mean, like I get the signaling. Like I've seen people say, well, if they go only 25, that's bullish. And if they go 50, it's bearish. But it's really about the economic data. I mean, they're very, very restrictive. In my mind, by their own admission. So in my mind, that actually lowers the threshold for them to do a big upfront move. Because even after 50 basis points, you'd still be actually quite tight.
There's a political consideration. Donald Trump gave a press conference yesterday, and one of the things that we've been hearing from the Republicans is any kind of cutting activity between now and the election is basically a political gift to the Democrats. We know that Powell doesn't want to play that game, of course. But do you think that might temper the possibility of larger cuts or quicker cuts? Or do you think they can look through it and just survive whatever the criticism is in the wake of their move?
It's a great question. I'm
very good at this.
To borrow from Austin Goolsbee, I hope not. I think not. But, I don't think it's going to matter one way or the other. I mean, you're sort of damned if you do, damned if you don't. So if they don't go and they do what they should do up front, then they'll have to do even more after the election, and that could look even worse.
Yeah, I mean, if it happens in September, they will have been on hold for 14 months, which is really long. It's not as if it would come out of the blue.
If they wanted to bail out the incumbent, they would have already eased.
Yeah, I mean, the idea that this election is going to hinge on 50 basis points is kind of wild anyway. The market didn't seem to focus much or react much to Trump's comments, which is kind of a reiteration of his stance that the president should have some kind of a say in Fed policy, monetary policy. Is there a genuine Fed independence question in play?
If Trump were elected?
We'll let you know in November.
I don't think so. I mean, I think that, this is him being him. I think that, the president does have a say in monetary policy. I mean, the Fed currently is Lisa Cook, Philip Jefferson, Kugler. I mean, these are all Biden appointees, right? So the president does have a say. It's based on the personnel that you put in there.
So I think that was a fantastic take on our markets and about so many different topics. Let me know what you think down below in the comment section of that clip you just heard. Now, CNN's Fear and Greed Index still sits at 24, which is technically still in extreme fear until you get to 25 or higher. Market momentum is fear, stock price strength is neutral, stock price breadth is fear, put and call options, extreme fear, market volatility is neutral, safe haven demand is extreme fear, and junk bond demand is also an extreme fear. This is one of those signs, or I guess indicators to say, there could be more upside in markets, at least in the short term. Again, if the data comes in not as bad as feared this week, which the expectation is 0.3% for retail sales. If you come in at 0.2, 0.1%, Wall Street's going to say at least it's not negative. That's positive. Okay. And I think you could get a potential move this week higher of almost 2% to this 50-day moving average. I would not be shocked at all if we're knocking on the doorstep of about 542, 543 for the SPY by Friday, as long as retail sales come in good. I don't think we get there until Thursday. So I really think Thursday you could get that outsized move, potentially to the upside. Now, for the bears out there, you have rallied a lot in a very short amount of time. You have rallied from the 510 low. Technically, you were at about 507 in pre-market that, what was this, August 5th. You've already rallied about 4.5%. There could be some room to come down and retest that 100-day moving average as support again. You really want to watch the moving averages around here. If you hold support at the 100-day moving average, that's good. And you've seen that on Thursday. You closed above the 100-day moving average. And you've seen support there on Friday, and then you just rallied, right? Gave some of it back, but you did end up closing positive, almost 0.5%. If we can start to move a little bit higher, then that 50-day moving average starts to look more in play. And I think just tactically in the short term, it really could go either way, but I am leaning more towards an upside move for this week. As you know, I'm in the hard landing camp as far as a, percentage, right? I think there's a 65+ % chance of a harder landing. Doesn't necessarily need to be a recession, but a lot more growth scare, right? A lot lower stock prices. So recession or not, I don't think matters. I think the economy will worsen, and I think there will be more fears of a potential recession. And I mean, look at 2022. We had a almost 30% decline in the S&P, and we did not go into a technical recession. This was just when odds of a recession went to 100% over the next 12 months. That was in October, and markets were down from the high, roughly 27%. So to see something similar would not surprise me if the data continues to look bad. And that could mean, let's call it 30% from here, would put the SPY back to about 395. Is that possible? Yeah, sure, it's possible. That would put you back to basically the lows of 2023. That would be a 28% down move from here. Is that possible? Yeah. That's basically where we were less than a year ago, or right about a year ago, 10 months or so ago. So yeah, do you want to be super bullish here? Probably not. But in the very near term, I think there is room for an upside move. So let me know your thoughts on this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. And if you made it to the end of this video, we will keep you informed and up to date in what's happening in our markets. And, well, I'm not afraid to tell you what's going to happen. Even if I'm wrong, usually right, sometimes we are wrong. So you guys have a great rest of your day, great Sunday, and I will see you in the next one.